Consumers, Joe, though, are in a foul mood, hit by higher prices, supply shortages, and a decline in fiscal aid. But they're expected, nevertheless, to have spent happily in January. January retail sales, they looking for a surge of 2.1%, more than reversing December's Christmas time surprise of a 1.9% decline. Take out autos, and there's still a 0.8% gain forecast. That compares to the 2.3% decline in December. So all that tells you the headline will be flattered by what's expected to be a sharp turnaround in auto sales, with manufacturers already having reported a 20% increase in unit sales. As with all such reports, however, question is, with overall retail sales, how much of the gains are coming from inflation, and how much more inflation can consumers shoulder before they start to pull back? So what we're going to do now is we're going to look at inflation-adjusted or real retail sales. They're up a strong 9% year over year. That tells you consumers have found a way to pay for inflation and still boost their real spending by 9%, at least so far. There was the 2.5% month-to-month decline in December, telling you maybe that consumers have reached a limit here, though of course there's some seasonal adjustment issues in there that may have exaggerated the decline. So all of this is of enormous interest to the Fed and markets as everyone tries to figure out how much tightening the economy can withstand in this battle against inflation. Can the Fed just cool the economy, or does it have to slow it down to at or near a recession to get a hold of price increases? Fed officials, they seem split on the strength of the economy and how aggressive policy should be between aggressive rate hikes and balance sheet reduction, or this go slow and steady approach that a lot of Fed folks have been talking about. So those differences we think are likely going to show up in today's 2 p.m. minutes release, Joe.
It's Andrew here, because I got a question for you, Steve, which is this. And I feel like viewers seem to get very upset when we talk about it this way. Do you believe that Jay Powell thinks about trying to reduce demand? Fundamentally, that's what I think he has to do. He's trying to reduce demand. But people seem to, when you talk about it in that context, they get very frustrated.
Yeah, I don't know what people think about things, but yeah, hey guys, can you guys in the back put that chart up, that real inflation chart up? Because it may help with the answer here. I think he has to think about bringing down demand towards potential of the economy. If you look at that, look at those two bumps in there. The bump down that's when the pandemic hit, and that bump up is right after that $1.9 trillion fiscal aid. People were sent money, and they went out and spent. Now, the hope is that some of this naturally runs off. You have the supply chain issues resolved. The second thing is you have this fiscal aid that really bumped up people's savings and their spending. You have that run down so that you get to a place where the amount of money in the economy equals the amount of supply in the economy equals the amount of demand in the economy. That's what I think Powell is hoping for. When you say decline in demand, I think he'd be very happy if demand came down, especially, and by the way, rebalanced itself. There's a huge goods component right now. Rebalanced itself from goods to services. That's what he'd be happy for, I would suggest.